Sector Alert, navigating US labor market shifts for smart investing. In Q2 2025, the US labor market revealed a stark divide between two economic realities. While the total job cuts reached 247,256, a 39% increase from the previous year, the pain was unevenly distributed. Government, retail, and technology sectors bore the brunt of the cuts, with government losing 288,628 jobs, driven by the Department of Government Efficiencies, DOGE, contentious restructuring, and ongoing legal battles. Meanwhile, media and news industries showed signs of recovery, with job losses declining by 46% compared to the previous quarter. For investors, these divergent trends offer a roadmap for tactical sector positioning amid economic uncertainty. The high-cut sectors, red flags for exposure. Government led the charge with 288,628 cuts, fueled by DOGE's restructuring and litigation. These losses, though politically motivated, signal broader fiscal tightening and reduced public sector spending. Retail, meanwhile, saw a 255% surge in layoffs, exacerbated by tariffs and inflationary pressures that stifled consumer spending. The technology sector, once a growth driver, recorded 76,214 job cuts, 27% higher than 2024, due to AI automation and visa policy uncertainties. Non-profits, hit by a 407% spike in job losses, face a perfect storm of shrinking federal grants and rising operational costs. These sectors aren't just losing jobs, they're losing confidence. The SP 500's Consumer Discretionary Index, which includes retail, fell 3.7% over 6 months, while information technology dropped 0.4%. Tariff-related uncertainty looms large, with potential trade hikes risking input costs and consumer caution. Investors overexposed to these sectors must tread carefully. The low-cut sectors, stability and resilience. In contrast, media and news industries posted a 46% decline in job cuts, with the news subset down 52%. This stabilization reflects a sector that has already undergone painful downsizing and is now in a holding pattern. Though not a high-growth area, its relative resilience is striking. The communication services sector, which includes media and advertising, outperformed with a 7.3% six-month gain, driven by subscription revenue and advertising recovery. Strategic rotation, where to allocate and where to avoid. 1. Underweight high-cut sectors. Government. Avoid direct exposure to public sector contractors and defense firms, as DOGE's legal battles and fiscal austerity could prolong instability. Retail. Tariffs and shifting consumer habits make this sector a high-risk bet. Retail ETFs like XRT, Consumer Discretionary Select Sector SPDR, are likely to remain volatile. Non-profits. Reduced federal funding and operational costs make this a defensive, low-growth area. 2. Overweight low-cut sectors. Media news. With cuts stabilizing, this sector offers defensive appeal. ETFs like XLC, Communication Services Select Sector SPDR, provide exposure to a sector with 20.9% annual returns. Technology. While job cuts are rising, the sector's long-term growth story remains intact. Firms with strong AI integration and cost controls, e.g. MSFT, NVDA, are better positioned to weather the storm. 3. Monitor policy shifts. The August 1, 2025 tariff deadline could trigger market volatility. Investors should hedge against trade policy risks by diversifying into sectors less sensitive to global tariffs, such as healthcare or utilities. Risk management in a fragmented market. The Q2 data underscores the importance of sector diversification. High-cut sectors like retail and government are vulnerable to macroeconomic shocks, while media and tech offer varying degrees of resilience. Investors should rebalance portfolios, Shift allocations from high-risk sectors to those with lower job cut rates and stable cash flows. Leverage ESG trends. European ESG funds saw a rebound in Q2, with inflows of $4.9 billion. Clean energy and sustainability-focused ETFs, e.g. ICLN, could benefit from policy tailwinds. Watch for liquidity risks. Non-profits and small-cap retail firms may face liquidity crunches. Avoid overexposure to thinly traded securities in these sectors. Conclusion: tactical moves in a shifting landscape. The US labor market's fractures in Q2 2025 are not just numbers, they're signals. By aligning portfolios with sectors that are stabilizing or growing, investors can mitigate risk and capitalize on mispricings. While high-cut sectors demand caution, the underappreciated media and technology industries offer compelling opportunities for those willing to navigate the noise. As the economic landscape evolves, agility, not just in capital allocation, but in perspective, will separate the resilient from the reactive. Why? 62,000 jobs were lost in July 2025. DOGE, AI, and tariffs explained. Over 62,000 jobs vanished in July, and it's all thanks to DOGE, AI, and tariffs, says a shocking new report. American employers have already slashed more positions this year than in the entirety of 2024. The reasons? Cuts to federal jobs, the rise of artificial intelligence, and Trump's tariffs. In July alone, private and public employers eliminated 62,000 roles, a nearly 30% jump from June and a staggering 140% surge compared to July last year. The running total for 2025 so far? Over 806,000 jobs wiped out, eclipsing the 761,358 lost in all of 2024. The government takes the lead in job reductions by a mile, slashing 292,294 positions this year. Tech follows with 89,251 cuts, then retail with 80,487. But here's where it gets controversial. The so-called DOGE impact is apparently the top reason for job losses in 2025. Trump initiated the single largest cut to jobs in US history early this year, offering over 2 million people a buyout. In just 2 weeks, around 65,000 accepted. Add 24,000 cuts in the Army and 10,000 in Veterans Affairs, among thousands more. On top of direct federal workforce cuts, reduced grant funding due to DOGE led to 17,826 non-profit sector cuts this year so far, a 413% increase from 2024. But AI is also taking a toll. Tech is the leading private sector for job losses, with 89,251 cuts in 2025. Advancing AI and uncertainty over work visas have contributed to workforce reductions, up 36% in the sector year over year. Major layoffs hit companies like Intel, 21,000, Microsoft, 15,000 across 2 rounds, PayPal, 2,500, and HP, 2,000. Then there are the tariffs. Retail and automotive sectors saw increased layoffs from Trump's global tariffs. In July, retail announced 80,487 job cuts, up 249% from 2024, citing tariffs, inflation, and economic uncertainty. Automakers cut 16,883 jobs, blaming tariffs, production fluctuations. US companies plan to hire 86,132 people in 2025 so far, up from 73,596 in 2024. Entertainment and leisure are driving nearly a third of hiring plans, potentially signaling a rebound in seasonal and service jobs. Insurance plans to hire 12,800, while automotive announced 6,161 new jobs. Hiring is down year over year in tech, construction, industrial goods, and energy. So what's the bottom line? July's job losses are a stark reminder of the challenges facing American workers, from government cuts to technological disruption and trade tensions. But with some sectors still hiring, there may be light at the end of the tunnel. The question is, will it be enough to offset the ongoing job losses? Only time will tell. July 2025, job cuts spike. Tech, AI tariffs impacting employment. The summer lull has officially come to an end, and the job market is feeling the heat. In July 2025, a staggering 62,075 job cuts were reported. With the tech sector, artificial intelligence advancements, and tariff impacts increasingly being pointed to as the culprits behind this unsettling trend. Challenger, a firm that meticulously tracks job reductions based on the location of company headquarters, provides insights into these layoffs unless specific announcements indicate otherwise. As we look at the data for 2025, the East region stands out with the most significant year-over-year surge in job cuts, skyrocketing by an astonishing 219%. The total number of job cuts jumped from 136,149 in 2024 to a staggering 434,385 this year. This alarming increase is largely attributed to substantial layoffs at federal agencies, particularly those counted in Washington, D.C. Notably, New Jersey saw its job cuts leap from 5,776 to 26,695, marking a dramatic 362% rise. New York also experienced a notable increase, with cuts rising by 43%, from 53,053 to 76,038. In contrast, several states faced sharp declines. Connecticut's job cuts plummeted by 82%, from 7,986 to just 1,440. Vermont experienced a 52% drop, and Massachusetts saw a 33% decrease. However, it's important to note that federal job reductions likely occurred in these states as well. Complicating the overall picture. Turning our attention to the Midwest, this region recorded a more modest increase of 8.7% in job cuts, rising from 82,279 in 2024 to 89,444 in 2025. The trends varied widely across states. Ohio experienced the most significant jump, with job cuts more than doubling from 18,802 to 37,938, a remarkable increase of 102%. Nebraska also saw a staggering rise of over 500%, climbing from 753 to 4,869. Conversely, Illinois reported an 11%. In the West, job cuts increased by 11%, moving from 182,290 in 2024 to 202,686 in 2025. California led the charge with 114,676 job cuts this year, a 50% increase from last year's 76,639. Arizona also reported a significant rise of 52%. However, not all states in the West fared poorly. Nevada and Oregon saw dramatic declines of approximately 79% and 61%, respectively, while Utah's cuts fell by 44% and Hawaii's by 52%. Interestingly, Washington state experienced a 48% increase, with job cuts rising from 17,887 to 26,524. Finally, the South region reported a notable 34% increase in job cuts, climbing from 59,812 in 2024 to 79,868 in 2025. Georgia was one of the states hit hardest, with cuts soaring by 72%. from 16,298 to 28,068. Florida also saw a significant rise, but here's where it gets controversial. Are these job cuts a sign of a larger economic downturn, or are they simply a reflection of a shifting job market influenced by technology and policy changes? What do you think? Are we witnessing a necessary evolution in the workforce? Or are these layoffs a troubling indicator of things to come? Share your thoughts in the comments.